SoFi Technologies is not your traditional bank business. It doesn't simply take deposits and make loans. It's got other business categories, including technology and financial services, that go beyond the traditional borrowing and lending business. But it still generates significant sums of revenue from lending, and the balance sheet is still concentrated in billions of dollars of loans. So the lending side of the business is important, although it's not the only part of its business. That's the focus of this video. I'll dive deeper into how lending progressed in its latest quarter and give more insights and details on that side of the business. Remembering, of course, that this is just one part of SoFi Technologies' business, that there are other segments of the business that are doing well and thriving. So SoFi Technologies investors have a lot of information to digest across a variety of the company's products. So let's dig into the lending business here. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So in its latest quarter, which was the second quarter of 2024, the company's personal loan originations reached a record $4.2 billion, and the management team said they're sticking to stringent underwriting standards. They've been a little more cautious in lending in 2024. Management came into the year expecting a macroeconomic slowdown, as was I, but the year has progressed much better than expected in terms of job growth, gross domestic product, and other areas of consumer consumption. So the management team is getting a little bit better results than it was expecting coming into the year. But that hasn't led the company to let go of their strict lending standards. They've stuck to that tight standard, even though the economy is performing better than expected. Home loan originations, which is something I've been looking forward to from SoFi Technologies ever since they made the acquisition of a home loan servicing company a few quarters ago. And finally, we're starting to see that paying off here with 71% home loan growth in the quarter. The reason why I'm optimistic or looking for more growth in this segment specifically is because home loans are less risky than personal loans, because home loans have collateral. So if the borrower defaults, SoFi Technologies can recoup some of their losses by foreclosing on the home, or it will also allow SoFi Technologies to sell the loans it originates to lenders who would be more interested in buying them, because those lenders would also know that they would have the right to foreclose should the borrower default on the loan. Unlike personal loans, where if the borrower defaults, SoFi Technologies is going to be caught holding the bag, or whoever owns that loan is going to be caught holding the bag, because you can't recoup that investment. I mean, you can try, and if the borrower is willing to pay you a small portion of what they owe you, even in default, then that's gravy. But most often what happens when a borrower defaults on a personal loan, that's a 100% loss for the company making the loan. Now, sometimes they'll get something back and they'll be able to negotiate with the borrower for a small payment or something, but there is no recourse that the company can take in order to recoup the investment. Whereas with the home loan, you can take legal action and recoup some of your losses. That's the big difference there. That's why I'm hoping for increasing growth in the home loan segment for SoFi, so the company's lending portfolio becomes lower risk. Student loan originations are finally growing again, which was a whopping 86% year over year. Remember, the student loan segment had been disrupted due to the unprecedented government policies regarding student loans, the pausing of payments, the potential for write-offs, the forgiveness of loans, all of which disrupted the student loan market. And that was a meaningful part of SoFi Technologies' business. But now that those policies seems to have ended and people have come to the conclusion that looks like we're going to need to pay our student loans. The government is not going to let us avoid or escape these. And so now the business for SoFi Technologies of refinancing some student loans and the student loan business is improving again. All right, so when we're talking about the lending business, the core competency here is how much you have to pay in deposits and how much you can generate in lending income, in net interest income, while considering that you can't make too risky of loans because then the defaults will outweigh any of the benefits you're getting. And so for SoFi, it reports this as net interest income, the difference between what SoFi has to pay to attract deposits and what it generates when it makes loans. And growth in net interest income was driven by a 40% year-over-year increase in average interest earning assets and a 27 basis point improvement in average yields. This resulted in an average net interest margin of 5.83% for the quarter, which was up 9 basis points year over year. And that's the key part here, is the net interest margin of 5.83%, which was up 9 basis points year over year. The increase in average interest earning assets is just achieved by making more loans. If you make more loans, you have more assets that are earning interest, right? Because when you make a loan, that loan is generating interest income. However, that loan also has risk of default. So you have to consider that in the equation. But when you get this expansion in the net interest margin, that means the bank is getting better at taking in deposits and making loans, in that it's not having to pay as much to attract deposits, and that when it makes a loan, it's generating higher interest rates. And so the spread, the net interest margin growing, is one of the more important things I look at when I'm evaluating SoFi Technologies stock. And it's encouraging to see it rise. Now, as SoFi, it hasn't been very long that SoFi Technologies earned its bank charter and was able to take in deposits. And that's been helpful because the price that SoFi pays to attract deposits is much lower than the price that SoFi had to pay before it could attract deposits. And so funding for its loans previously through wholesale facilities and other methods cost the company a higher interest expense. And so the spread was narrower because it was paying a higher price for the money for the loans. But now that it gets the money for the loans through deposits, that cost is lower than from wholesale facilities. So that's been a tailwind for SoFi Technologies' net interest margin. And I talked about the risk of the personal loan borrowers, and SoFi here points out that personal loan borrowers have an average income of $168,000 with a weighted average FICO score of 747. And this is evidence of SoFi Technologies' stringent lending standards, only making these loans to, or I shouldn't say only, but weighing more of their loans to higher income consumers with a much higher FICO score. But then you can argue, if you've got an average income of $168,000, why are you taking out personal loans? That doesn't seem to me that is a person of a good credit risk, because if you're making $168,000 annually and you still need to take out personal loans, which come with significantly higher interest rates, then that goes to question your financial management. How are you spending this much money in a year and going beyond that in order to need personal loans? And so this traditional scoring method, some college student with maybe 1 year of credit history might have an excellent FICO score because they've made all their payments on their loans for 1 year. But are they really a good credit risk? I don't think so. And I would say probably not. I don't think they have enough history to determine if they're a good credit risk. So even though SoFi Technologies highlights that, they're going after, the top tier borrowers, I'm a little bit skeptical of that with SoFi Technologies. Now, throughout this video, you may have, seen my tone being a little bit more risk averse and being a little bit skeptical of SoFi Technologies and their risk parameters and what they try to convince of investors of in this video. But that's just the nature of how I approach investments. I take a greater focus on the downside because the upside can take care of itself. You don't need to worry about the upside. And in fact, I have SoFi stock rated as a buy. And so even though I've been skeptical with some of these things that they've been talking about, highlighting some of their risks and all of the things that they're doing that are increasing or decreasing risks, overall, I still like the company's prospects longer term, and I do think it's a good risk versus reward for investors. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.